Good morning everybody and welcome to this week's Motor Trade Radio podcast in association with eBay Motors Group. It is Saturday the 22nd of August and you are joined by myself, Philip Northard.
And me, Curtis Hutchinson. So episode 373 and we're live on your radio from West Yorkshire and Surrey.
And Surrey, yeah, and I do apologise that I have got an extra sensitive microphone and they have just decided they're going to start to replace a lamppost outside and currently drilling the tarmac. They're cutting the tarmac there, so if you can hear a slight noise in the background, it's probably about half a mile away and my microphone is picking it up perfectly. But yeah, do apologise for that one.
Or if you go offline, it just means they've cut your broadband, so it will be a solo show.
It would be, yeah. And let's not go back to the good old days of delays and things like that. With before I had the benefit of fibre, Curtis?
Yes, yeah.
So we've got again jam-packed show, haven't we? I mean, as you say, episode 375. We've had a fantastic interview this week with Adrian Dally from the FLA, who was sharing some of his views on the finance performance year to date for the automotive motor sector. Talking about obviously the recent decisions from the FCA and talking obviously about PCH and that kind of thing, wasn't it? So it was quite an insightful interview there with Adrian.
Yeah, it's an interesting one, and as Adrian points out, the FLA actually accounts for 94% of all finance sold, all motor finance sold in the UK. So he speaks with some authority.
Yeah, and I mean, it was nice to hear as well, obviously, that the relationship that they've got with the FCA, and that the FCA do listen to them, and they've got quite an influence on there, and obviously how closely they do work currently and for the future with the FCA.
Yeah, I thought that was particularly interesting because we've touched on this consultation process that started last year, and Adrian makes it quite clear that the FCA were listening. I mean, yeah, they were listening to the automotive sector. So we've got that interview at the end of this programme, so do stay tuned for that.
We have. Do you want to go through some of the headlines? We've got some meaty headlines this week, haven't we, with a few announcements this week?
We've got some great headlines this week. We've got this fascinating suggestion from Dash Gupta at Marshall Motors that his business would be happy to switch to an agency model. So we'll pick up on that. We've got interims from Marshall's, a trading update from Virtue, and we've also got a trading update from Lookers. Virtue and Lookers are particularly interesting because they're talking about that June-July period. Will there be fewer new car models to choose from in 2021? The SMMTs, Mike Hawes, thinks so. So we'll see what he has to say. Used car stocks were down by 22% in July, according to Indicator. And finally, this week, we've got President Trump on the programme.
Yeah.
Making a rather surprising attack, although nothing he says really is surprising. But he makes an attack on an iconic US automotive brand.
I mean, that is. I mean, there's always it's always good for something, isn't it, on a daily basis coming out of President Trump there. But this is specifically connected to the automotive sector, so yeah, it should be a good one, that one. So we'll get off with the first one, and as you say there, I mean, there's an interview and catch up with our friend Dash Gupta from Marshall's Motor Group, and the headline at AM says Marshalls would wholeheartedly embrace new car agency model, and this one really got some interest, didn't it? I mean, particularly in the social media space. I mean, the views and some of the comments were particularly intriguing. Not with sort of the comments in there from Dash Gupta, and it got you thinking a little bit, Curtis.
It did, yes.
What's been happening in this sector since the really old days that you thought was, when there was potentially agencies, and that was the way sort of franchise dealers may have been initially set up back in the day, should we say, Curtis. But yeah, it's quite an interesting one, this one, and I think there's probably a lot more to go into on another day.
Yeah, and when you say back in the day before I came into the industry, I hasten to add. But this is all about the agency model, which is basically OEMs paying dealer groups a handling fee for the sale of new cars, which for the dealer means that they don't have any stocking costs and don't carry that debt. But obviously they retain finance and after sales. So why wouldn't you like this model, which is really what Dash is saying. Now, I posted something on LinkedIn saying this sounds like a really good idea. Wouldn't this be going back to the old model? And I was kind of inferring, from the 60s and 70s. And Dash actually responded by saying that Marshalls actually has a number of brands on an agency model right now. And he says, it's a good thing. We have no stock, no stocking costs. We have no debt. What's not to like? So this is just fascinating because I didn't realize that the agency model existed at the moment, but clearly it does in some instances.
And I mean, it's kind of, in a way, this touches on a little bit of the stuff that Adrian Dally was talking about from the FLA as well. There is this move, and we've seen it for some years, haven't we, around this, this level playing field of commissions, level playing field of finance incomes and finance rates and things like this. And you can see where, gone are the days potentially of, variance of vehicle pricing, and talking huge variance of vehicle pricing, huge variance of finance rates and commissions and things like that. But actually now, as Dash has said, the net margin, not all manufacturers, but the net margin for some manufacturers is reasonably low. I think some of the manufacturers and retail dealers have struggled over the years in terms of chassis retention of a new car through volumes and pricing structures. Even back in my day, there was a move towards very minimal margin costs of new cars. Very much 1% related to your CSI standard, etc., etc., etc. So there was less margin to play about with. It was really minimal, and you can see why this would be very attractive in the current market for the retail dealers. As you say, Dash has talked there about not carrying the stock, so it reduces that consignment risk. It reduces that balance, your overdraft balances, etc., etc. And you know what? You just get that fixed fee for every single vehicle that you register, and in many cases it could be more than some of the retailers are probably making today on some models.
Yeah, because in the AM piece, Dash actually says it would hand back tens of millions of pounds in cash for the business because, as you say, they're not liable to those stocking fees. Now, on LinkedIn, I had some interesting feedback. Nathan Tomlinson from Devonshire Motors, a friend of the podcast, he's been on a couple of times. He said he absolutely applauded Dash for the comments. He thinks it's a good thing. Steve Deeney from Williams Motor Group, he raises the question as to whether block exemption stops an agency model with regards to targets. That's an interesting question. Unfortunately, Steve, we don't have an answer, but we've been thinking about doing a follow-up on this and getting someone from the industry in to actually talk about the franchising model, the agency model, and where it's going.
Yeah, and I think it's a good time to do that. I think in terms of the recovery of the franchise dealer network, we've got obviously Brexit. Brexit has happened. We've got the WTO at the year end facing the sector. With lots of conversations around the tariffs. One of the stories, which is the one from Mike Hawes there, around the vehicles coming into the UK following not being part of the European market as well. So I think it's probably a good time. And block exemption, you raise block exemption there. That is certainly a topic within the franchise dealer network that is imminent. It was years off at one point, and now it's getting closer and closer. So I think you're right. I think we'll try and get an industry expert on to shed some light on some of these areas on one of our special interviews, and we'll come back to you on that one when that is arranged.
Yeah, now the next three stories are all based around financials, and the first headline from Motor Trader is Virtue runs the rule over acquisitions in months ahead. This is based on a story that on Virtue's trading update for the month of July, which is, I mean, it is interesting because that's the first full month of dealerships being open across the UK. So we'll get onto the acquisitions in a minute, but for the trading update for July shows that on a like-for-like year-on-year basis, new car sales were up 18.1%, used car sales were up 13.7%, vans were up 4.5%, and Motability was up 38%, and this means adjusted profit before tax of 7.4 million in July. So that's a strong reopening there from Virtue.
It is, yeah, and as you say, I mean, the interview is still available to listen to with Robert. That was probably one of the first COVID-19 special interviews that we did as we entered lockdown, and Robert talked about obviously the activity that was taking place throughout lockdown, particularly in his after sales and his van sector of the business. So he was very much active in one form or another throughout lockdown, and really getting ready for when they could operate from the 1st of June and get fully operational again, and he's been a leader with that, hasn't he, throughout lockdown and at the start of the restriction lift and recovery. So you can see where that has come, and he's always had aspirations for further growth, further investment, and further acquisitions. And you know, in both the stories, there is talk about obviously opportunities when they arise for acquisition, and I think that's the key at the minute. It's not a case of, you know, there's probably going to be a lot of opportunities. It's just whether they are the right opportunities for growth and the right thing for their shareholders, because that's the key with it. You know, is an acquisition the right fit for their business in terms of their strategic partners, and is it the right for their shareholders?
Yeah, and it is interesting because in the story it makes it quite clear that several growth opportunities are currently being evaluated in terms of acquisitions. So watch this space. I don't think we'll have to wait too long. But just returning to July, what really caught my eye, because I went and had a look at the trading update, the group generated record levels of used vehicle gross profit for the month, with like-for-like volumes of up 13.7%. So used vehicle margins remained above normal levels, which is really showing the strength of the used car market at the moment. And we will return to the used car market later in the programme, but there's some interesting trends there.
Yeah, you're right. I mean, it's what we've been talking about on a daily basis at the minute, is that supply and demand and the strength of that used car market. And when Clive Buck was on with his interview talking about his June recovery and some of the trade profit that he was talking about, you know, it was really, that was the time to maximise your used car assets. You know, the market was strong, the demand was strong, and the retail prices were holding, if not going up in some cases, and that's been reflected through the wholesale market as well. So you're right. I think that's the key for used cars is what's going to happen going forward in sort of the end of Q3 into Q4, but that one's for another day. So returning to Marshall's again, and this is again returning to AM, and Marshall's Motor Group ready to acquire as UK market prepares for further consolidation. It's kind of referring to what we were just talking about there with Virtue, isn't it? That opportunities presenting themselves for further growth.
Yeah, and these are based on comments made by Dash Gupta, who's saying the impact of COVID-19 will accelerate the rationalisation and consolidation of the UK dealer networks. But the group, he says, is well placed to capitalise on value accretive growth opportunities. So again, the big dealer groups, and we've talked about this before. This emergence of super groups, which I know is something that Dash is very much at the forefront of saying that this is the way the market will grow. Well, there are opportunities, and the major groups are looking at this. But going on to the interims, so the interims are for the 6 months ended June 20th, and it does show how much the pandemic has affected the group. So revenues for the period were down from 1.18 billion to 895.3 million over that 6 month period, with profits before tax dropping from 14.8 million to a 10.7 million loss over the period.
And I mean, Dash was fairly vocal where I think he pushed back on comments that were out in the market around the size of the groups, and like you say, the super groups, that's not possible because you start to lose control and your staff and things like that. And Dash has rightly proved, the speed in which they've grown and grown through acquisition, and still maintained the loyalty level and one of the leaders from an automotive perspective in the best company to work for sector. So, he's quite rightly pushes back to say, do you know what, we can do this if it's done strategically and correctly with the right partners and the right leaders within the business. And I think there's a testament to Dash and his team, and the same to Robert, really, that fantastic results from both those businesses in what you might call a challenging time for the sector in the first half of 2020. And as they say, there's important description of opportunities that the pandemic will create, and these guys are in a strong position to capitalise on those if they are the right fit for the business. So I suspect we'll see a lot more in the short term from both Marshalls and Virtue.
Yeah, now the next headline is from Motor Trader, and it's Lookers sees some signs of recovery in July after H1 loss. So again, this is looking at the period of June and July as dealerships started to reopen, and Lookers said they had a better than expected reopening in terms of vehicle sales and after sales. So during July, on a like-for-like basis, it invoiced and delivered over 14,000 new retail and used units, which was up 17% on last year, and like-for-like service revenues also grew. So that's the positive picture coming out of this year. But of course, we still don't know how Lookers closed last year because of the internal investigation, which has pushed back their year ends. And they announced this week that the year ends will not be published in August. They will be delayed, and this will be for the fourth time as the investigation into past accounts has actually been expanded to cover its leasing operations.
Yeah, and it's kind of a self, it was a self-imposed deadline at the time that they were going to obviously publish. We know that shares have been suspended because of the non-publish of the accounts, so the shares still remain suspended currently on the stock exchange. But as you say, it's still ongoing. I think there was obviously indications of the amount of the impact, but again, like you say, they're still investigating and actually still looking for support in auditing, aren't they? I think there was in Auto Retail Network there was a story where they were continuing to try and employ auditors to help speed this along and move forward with it. So still a lot to come out from Lookers, and we hope the best for everybody within Lookers through this, and hope that eventually we do get the results and they put it behind them and move forward, because it's not what you want in these challenging times with everything else. Just whilst we're talking about retail, the UK retail sales were published this week, and they actually I think they were better than many of the analysts expected, because the UK retail sales beats estimates with a plus 3.6% month on month in July. So they are fairly positive around the retail sales compared to what had previously been published and estimated and forecast.
Yeah, which kind of defies all logic, doesn't it? Especially as we're officially in a recession again.
Yeah. I mean, they're talking about the borrowing still set to a total of 17% of GDP this year, despite the decline in monthly trend, and the public sector net borrowing, excluding the public sector banks, was 26.7 billion in July. But that was below the consensus of 28.6 billion. It's a bit odd, isn't it, when you're talking about a positive from a 26.7 billion versus 28.6 billion in terms of borrowings. But again, it's testament that when we're talking about the automotive sector, when you look at those results from Virtue and Marshall's, just two of the ones that we've highlighted, that all counts towards this recovery of the retail sector.
Yes, and just to give it a bit more context, only today it was announced that UK government borrowing topped £2 trillion.
Yeah.
and that's in the same week that Apple's revenues hit a record high of $2 trillion.
Yeah.
So yeah, what's going on?
Some big numbers.
Now, you're listening to the Motor Trade Radio podcast in association with eBay Motors Group, the only weekly podcast serving the car retailing sector, and available by subscribing on Apple Podcasts, Google Podcasts, Spotify, Deezer, SoundCloud, and of course, the Radio Public app.
That's the one. So, I mean, moving on to the next story. So we're going over to Car Dealer Mag, and they've had a brilliant run throughout lockdown, haven't they, in terms of some of the interviews. And this week, they've managed to get Mike Hawes from the SMMT on a live chat, and obviously there's a press release on the back of it. And this is referring to what you mentioned earlier, Curtis, around the fewer models on offer in car showrooms from 2021 due to UK's adoption of strict EU CO2 emission regulations. And it's quite an interesting one, this, because there's a lot, and again, this is an area that we maybe need to get somebody on that put a little bit more sort of expertise around it, of potentials of WTO, Brexit, block exemption, etc. But it's all kind of related, this, isn't it? It's quite an interesting one.
It is, and it does raise a number of questions, which is why it'd be good to get someone on that we can address these two. But as you say, speaking to Car Dealer, Mike Hawes said that the UK's adopting a copy and paste approach to the emissions regulations, and this will result in less choice for customers in terms of the number of models available. But he says there will be a greater selection of powertrains. Now, we need to see how this one's going to play out, because he goes on to say that small niche products, especially ones with high CO2, might be very profitable, but to what extent can the manufacturer offset these vehicles with lots of smaller, more efficient models? So it is a quandary, this one, because any vehicles sold in the UK from next year, do they count in terms of average CO2 emissions across Europe? I don't think so, because we're out of the EU. So how manufacturers supply the UK from next year is there'll be different rules applied to which vehicles they want to sell in the UK.
Yeah, it is like I say, it raises lots of questions. I mean, without getting too political on it, you've got your WTO now, which we've obviously got the threat of tariffs as vehicles come into the UK. There's lots of conversations around that. There is recovery in the top four, should we say. It used to be top five of the European five, but there's a lot of recovery in that market at the minute. The UK, out of all of them, are the one that really the government hasn't identified separately from any stimulus to the automotive sector. If you look at the Germany, you look at Italy, Spain, France, they've all added and supported the automotive recovery sector in those countries. So I suppose a lot of it is how the manufacturers will be looking at the UK as they go forward. And as you say, at the minute there is this view of the copy and paste, that the regulations and legislation from the EU into the UK in the short term. But how will the manufacturers relate to that? And this is added to conversations that you and I were having before the podcast today, that what's happening with things like PSA, with Peugeot, Citroën and Vauxhall, and potentially Fiat at some stage. We've seen the exit of Mitsubishi in the UK and the European market. We know there's challenges around some of the other manufacturers such as Honda and other manufacturers in the UK, and it creates a question as to what will the UK new car franchise look like in the long term. I mean, recently we talked about the I think it's City Car or Superman. I think it's City Car. Correct me on this one. But 3 years ago, I think there was 24 models, 24 generations, derivatives, and now there's 11. So you can see where model lineups are reducing. That you're going to get crossovers. What will the PSA look like in the long term? If you've got competing models within the same segment, within Vauxhall, Citroën and Peugeot, it starts to create what that new car market will look like. And as you say, in terms of engines and model trains and things like this. So, it's a lot to be worked out, I think, and I'm not sure anybody's probably got the answers for it, but I'm sure we'll try to see what this looks like in the future.
Yeah, and it does follow on from the conversation we had recently with Dale Wyatt from Suzuki, because Suzuki you think of as being a specialist small car brand, but even Suzuki have had to discontinue some of their models because of these new rules and regs. They would push their average CO2s up too much, so their lineup is changed quite dramatically over recent times.
And it refers back to our opening press release, around Marshalls with the agency model. Is that why? Is that the answer, that actually you just become an agency model for multi brands, and therefore you can manage your volume, you can manage your revenue a lot easier, and your risk is reduced because of your cash back in the bank because of the reduction in asset investment from the new cars. So it will be. I think there's a lot to come. Whether that's in the next 5 years or 5 years plus. I think there's two strategic looks at this now. That actually there's probably a strategic planning for the next 5 years, and then what that looks like 5 years plus. And they could look totally different. But again, ones that we need to raise. And going over to used cars now, and again, you referred to it earlier around the impact of the used car market, and this is in AM Online, and the headline is UK used car stock down 22% in July, and as you say, this comes from Indicator, and we have interviewed Andy Shields from Indicator that gives some insight into what they do and where they do it, etc., and this is where they have got sight of some of the used transactional or advertised data across some of the European markets as well, and they've been looking at the recovery of since lockdown in the UK and how that compares to some of the European countries as well for used cars.
Yeah, so as you say, the findings show a 22% shortfall in used car stock, and that's between April and July, according to their latest Market Watch report. And digging down a little deeper into the report, it shows The lack of stock resulted in what they calculate as being an average used car price rise of 1.7% in July, while sales overall fell by 1.8% over the course of the month, resulting in those stock shortages compared with the 3.7% rise in June. So it does show that we keep going back to the used car market because it's so important at the moment, and there clearly is a shortage of supply and high demand at the moment.
Yeah, and as you say, I mean, that was clearly highlighted in Virtue's results, wasn't it, around their profitability within the used cars, and that many of the dealers at the minute are having to maximise their return because the stock isn't coming through in any kind of free, in any huge volumes. It is limited supply, and the retailers need to be very strict on what their stock policies are and maximising the return on those vehicles. So again, we do keep coming back to it, don't we? Because of the challenges facing the new car market, as we've just been talking about, actually that puts further pressure on the used cars to make sure that maximises income from the used car department. So
and they also highlight that cars aged between 6 and 9 year olds, they continue to be the most popular, which is something we've been talking about for a couple of months now.
It is. And finally, we have got... It isn't, and finally, anyway, I think this one, that we've got a cracker from BBC News.
We're allowed to have a laugh at this one, I think.
Yeah, and as we said earlier, we've never really talked about some of the political antics over in the US, is probably the best way of referring to it, and what comes out from President Trump. I mean, everybody's obviously fully aware of some of his Twitter comments and things like that, because they are very much well covered on the news. But this one actually is directly connected with the automotive sector, and the headline is that Trump attacks Goodyear for campaign clothes ban. And it's quite an interesting one, because we were talking about this right before the show, and that he's had a dig at Goodyear, and now he's talking about telling the Americans not to buy Goodyear tyres and to buy other tyres instead of buying Goodyear.
Yeah, and let's not forget that Goodyear is one of the most iconic US companies, not just one of the most iconic tyre companies, but one of the most iconic companies of all. And it's all what happened is that Goodyear made it clear to employees that they've agreed not to wear any clothes promoting political causes or campaigns, and the Trump administration, or certainly his followers, have got hold of this, and President Trump has been tweeting about a ban on wearing the "Making America Great Again" cap and shirts, and Goodyear have launched a robust defence saying, well, that's always been part of our agreement with our employees. They're not allowed to wear anything advocating political parties in the workplace. And
it's quite because there's a documentary on BBC iPlayer about Donald Trump and his social presence, and how it started and how it's evolved. And they had a campaign manager that was initially doing his social posts and things like that, and then eventually started to take over it himself. And it is worth a watch. It's very amusing. It's worth a watch.
I've seen that.
Yeah,
it is very, very good.
It's
fascinating that initially Trump was totally disinterested in social media, and then the penny dropped.
Yes, yeah, it was quite amusing. And the actual tweet is published on the BBC news release, and it says, "Don't buy Goodyear tyres. They announced a ban on MAGA hats. Get better tyres for far less. This is what the radical left Democrats do. Two can play the same game, and we have to start playing it now." End of tweets. and that is shared by a gentleman called Jared Brown, and he's put that it's absolutely despicable that the president would call for a boycott of an American company based on Akron that employs thousands of US workers. So it's getting very, very heated, and as we've obviously got the date. What would you say? 70 odd days away now.
We have 75 days left of this,
and it's going to heat up, I suspect.
It is, yeah.
So I think quite interesting, quite a nice way to finish the story there, because as you say, it's brightens up the day to, if nothing else, read President Trump's tweets. It certainly puts a smile on your face with what does come out there, and I'm sure, as you say, for the next 75 days there is going to be plenty of headlines for the news to pick up on from the US election, but we'll try not to get too political on this podcast. I think this was purely because it was connected with Goodyear's tyres, but
yes,
we'll keep an eye on this one just in case there is further pushback from Goodyear, because they have tweeted back on in response to President Trump and put an official statement out as well around it, so we'll keep you updated with that one. So I think that's it for this week. We've some cracking headlines there, lots to talk about, and as I say, we opened up with that one from Marshall's with regards to agency businesses and what Dash was referencing there. So hopefully, as we say, we'll try and get somebody on a little bit more impartial than Curtis and I, that can sort of give a view on the franchise model for the UK following the exit from the European market. There's obviously everything going on with block exemption that is getting closer for the franchise dealer network, and maybe we can start raise the questions around the agency models and where that is evolving with manufacturers in the UK, and maybe even touch further on the model lineup and what the impact of the CAFE legislation and push towards reducing the CO2 output in the UK and Europe. So hopefully we'll get that, and we'll announce that. We have got a special interview hopefully lined up for next week, so we'll hope that one will stay, and that'll be quite interesting as well, and hopefully share some insight into an area that we've not really gone into on the show previously.
Yes, so that's all for this week. You've been listening to the Motor Trade Radio podcast, brought to you in association with eBay Motors Group. Do stay here for our interview with Adrian Dally, Head of Motor Finance at the Finance and Leasing Association. As we said, it's a wide-ranging chat with Adrian, and he talks about how the finance market has been performing since June. Also, his thoughts on the impact of the September plate change, and also some fascinating insight into the whole consultation process with the FCA, which led to the banning of discretionary commission payments on finance sales. So do top up your coffee and stay here. In the meantime, join Philip and I again next weekend for our regular review of the headlines, and do look out for our next interview, which will appear in your podcast feed sometime in the middle of next week. Until then, it's goodbye from me.
And it's goodbye from him. Hello and welcome from me, Philip Nothard, and Curtis Hutchinson to this special Motor Trade Radio podcast, brought to you in association with eBay Motors Group. So many thanks again for joining us in the latest in our series of special interviews themed around sharing best practices for car retailers as they continue through their way to manage the COVID-19 crisis. Previous interviews are still available with people such as the Suzuki boss Dale Wyatt, Mitsubishi MD Rob Lindley, Marshall Motors Dash Gupta, CAP HPI's Devon Martin, and Clive Brooks of Clive Brook Volvo, and many more are still available to stream online from Apple and Google Podcasts, Spotify, SoundCloud and Deezer.
Well, today we're delighted to welcome our special guest, Adrian Dally, Head of Motor Finance at the Finance and Leasing Association. So welcome to the show, Adrian.
Good morning, Curtis. Good to hear you.
Yeah, and you, great to have you on. Now, regular listeners to the Motor Trade Radio podcast will be familiar with our monthly look at the FLA finance figures for new and used car sales, which we'll look at in a moment. But before we do, Adrian, can you just give listeners a brief backgrounder on the FLA and what your role is regarding motor finance?
Yes, the Finance and Leasing Association, which is what FLA stands for, is the trade association that represents finance and leasing companies throughout the UK, and those finance and leasing companies that provide services to both business and consumers. And in this context, that includes the motor finance providers, whether they're the captive finance providers that work with the manufacturers, or the independent ones that often finance used car sales. So they're all in our membership, and collectively this matters because 94% of new car sales are backed by finance provided by an FLA member. So that's who we are, and that's our background, and that's how we sit in with the work the dealers do.
So, I mean, welcome, Adrian, and eventually we've managed to get you on the show, and obviously we do speak on a regular basis, so fantastic, and welcome to the show. So we've obviously there's lots to cover, obviously with what's been happening in that finance sector, and and the best practice, the best place, should I say, is probably to start with the FLA's recently published figures covering June. And the month dealership started to obviously reopen, albeit staggered through the UK, and obviously what's been happening in the first half of 2020.
Well, indeed, the figures recently out for June show two particular things, not exactly the same, and dealers will have been noticing this quite considerably, I think. The good news is that the volume of used car finance has gone up by 2% compared to June the previous year, which is probably the best way to look at it. On the other hand, the volume of new car finance has gone down by 21% compared with the same month last year, June last year. So looking at things positively, you could say that there has been a pretty sharp V-shaped recovery for used car sales, given that that the track for finance follows the track for the cars themselves. The finance is the ancillary product. So you've had a strong V shape there, indeed a bit of growth compared to last year. Not quite the same for new cars yet. 21% down on this time last year, or 79% up from the base in the heart of lockdown. You could look at positively. So not a complete recovery yet, but there's obviously been challenges in the wider supply chain that go towards that. But yes, that's for June. I think in the heart of lockdown, if you were told before June that that's how June was going to pan out, I think you'd probably be fairly pleased overall.
And as you say, from those figures, we can see that the recovery in June was led by used car finance demand. What's your expectation for July? Because I guess that's very much the key month, isn't it? Because that's the first full month of dealers being open across the UK following the lockdown. And we know that new car registrations increased by 11.2%, which was we also know was powered by retail demand. So how do you see the July figures panning out?
Well, early indications are pretty positive, actually. There's obviously been some speculation as to whether the strong June we saw was all about pent-up demand, and therefore there'll be a dip, especially with September coming. However, we haven't really seen that yet. I mean, obviously, not all the data's in, so not yet a full picture, but it's certainly looking at the more positive end of the spectrum. Used car market remains strong, and I expect to see some good numbers there as well. But as you say, in July and August, new car volumes and therefore new car finance volumes tend to have a bit of a dip before September. It's not looking quite like that, I have to say, but a week is a long time in many things. But it's certainly looking reasonably positive. And of course, there's been breaks in the supply chain during lockdown as factories closed, which then shift the timing of new car acquisitions as well. And there's certainly an element of that going on. But it's looking more positive than we thought it did, that's for sure.
And as you say, Adrian, I mean, obviously June was really the first month since lockdown and really the first clear month. But July, now we've got sort of Scotland and Wales fully on board for the full month, and will give us a full clearer picture. But I mean, what's your take on demand for finance and what is likely to pan out over the sort of the coming months? I mean, especially as we're now coming away from the furlough support from the government. We're in that reduced stages now, and we're actually on a regular basis through the consumer sector we're seeing increases in job losses. So what's your take on that and around consumer debt and the demand for finance?
Well, it's a very interesting situation, and the commentators always say that no two recessions are the same, and it'd be churlish not to acknowledge that we are in recession now, and therefore clearly that has an effect on pretty much all markets, including the automotive one and the finance sector that supports it. So clearly there's going to be effects across the board, as in any recession. However, one of the characteristics of this one is that it's in some respects quite polarizing compared to previous recessions, where yes, there is a percentage of the population that could increase significantly as the furlough schemes end, who are very, very adversely affected by the COVID situation. Much more deeply than in other recessions, perhaps, and that's a matter of grave concern. And clearly, finance companies have been providing a very significant level of forbearance to those customers over recent months through what's often called payment holidays, or what we prefer to call payment deferrals. So very significant impacts there. But for the rest of the population, 80% plus, the situation hasn't been quite so stark as in previous recessions. Indeed, the savings rates have gone up for that population on average, and for many of the 80% of the population, their financial position may actually be better. So it's a complex market. How this pans out post end of furlough and when the government support schemes start being rolled back, we don't know. Is the honest answer. But it is a fairly polarized situation there. But it's a more complex one than in typical recessions. But certainly, as finance companies, clearly we've had our moral, social, and economic obligation to provide support to customers who have been adversely affected by the crisis, and indeed those that will be affected in the future as well. That does mean a significant loss of income in terms of the support we're providing in terms of forbearance. But clearly, just like the motor trade generally, for a number of weeks, effectively the motor finance sector closed down as well. There was no new lending going on because there were no car acquisitions going on. And from a lender's point of view, if there's no lending, that means no future income from your loans. And therefore, there is potentially something we're concerned about, which is over the medium term, the impact of the forbearance we've been providing does impact your cash position as a lender. The defaults that inevitably arise will affect that too. The loss of future income from the lockdown will have an impact over the medium term, and potentially issues like residual value fluctuations could have an impact as well on the profitability of loans. This is not to provide a scare story, but it does significantly change the cash flow for lenders over the medium term. We've obviously been in very close talks with the government and the regulators about this going forward, where clearly, as the economy recovers, it's very important that finance companies are there to provide support in terms of lending and other forms of finance to businesses and consumers to acquire assets, including cars. Very important that we remain there and able to lend. And I'm confident that will be the case. We will be there as a finance sector to support dealers over the medium term. But that doesn't happen automatically, and there will be challenges along the way.
And just before we move on to Curtis, just in terms of, this week in the Times there was an announcement that the British Business Bank has extended deadline for their business loan schemes, and that's sort of the medium-sized and larger businesses for the extension. Do you think there is possibility, I mean, you're saying you're in conversations with the government, and do you think things could still change around that sort of support for the motor finance sector in general, or consumer loan sector?
Well, the government is saying today that there will be an announcement on the future of those support schemes next month, and we take that to mean that they are considering options, including extension of the support schemes, and that's something we would certainly favour. Pulling the plug on support in too black and white a way could have negative effects in a very significant way. So we are asking the government to continue to provide support over a longer period to support the recovery going forward, and that reflects the position that the finance sector has to play, because without finance to support acquisition of assets, whether you're a business or a consumer, then that part of the economy doesn't grow, and that really matters. And one further aspect that we're obviously conscious of is that if you look at the data on the impacts of COVID on different parts of the economy, I mean, clearly hospitality in all its forms was by far the worst affected, but the next level down, the three A's were the ones affected most: aviation, aerospace, and automotive. And so we do expect the government to recognise that, because these are all areas, automotive in particular, supports employment in every single town across the four nations of the UK. And that's really important that this sector remains viable and vibrant and can continue to support customers and businesses through the recovery and beyond.
Yeah. Now, Adrian, the other big story impacting car dealers really came to the fore last month when the Financial Conduct Authority formally banned the discretionary commission model for car dealers. And we know that will start from the end of January 2021, which is good news for the sector because it does give everyone time to prepare for that. Now, the FLA was involved in the consultation process, which I believe started back in October last year. Can you tell us how receptive the FCA was to the dealer model, which is unusual from other models in terms of selling finance, and how does the FLA feel about the ban?
Well, in terms of the ban itself, we very much welcome it. It's something we've been arguing for a long time, and let's be honest, what's being banned is something that's effectively stopped already and has been in transition out of for many years. So it's a very positive move. It gives parameters to the market, creates a level playing field. So undoubtedly, this is good for the players in the market, and ultimately very good for its customers. So pleased to see it's over the line. Also very pleased to see that the FCA listened to us in terms of the challenges in implementing the new model at a time of the COVID crisis. So they've given us extra time on that, which is a very good move. And now we've got clear certainty around which to plan for the future. But in terms of the position of dealerships, absolutely, I think the FCA has always had its eyes wide open on how the industry works. At the end of the day, when it comes to car finance, the vast majority of cars have to come through a physical place, a dealership, and that's where the vast majority of customers engage with both the vehicle and with the finance. That is just the way it is. Okay, the market is growing more diverse, but that's far numerically the biggest part of the market. And there are plenty of other ways in which financial services are provided in that kind of model. So the issue is not whether finance should be provided this way. It's more a recognition of the fact that this is the prime way of providing the finance, and how can that be done in a way that's continuously improving. So that's absolutely goes with the grain of where the FCA are going. There's been initiatives for a long time that dealers have strongly embraced, like the SAF, or Specialist Automotive Finance Programme, which is about constantly raising standards and giving dealers the tools to confidently and safely sell finance and continue to do so. FCA think very highly of those industry initiatives and are giving us the encouragement to develop those. So to be honest, I think the way I would look at it is that actually the FCA hasn't rolled out many new rules on commission. There's only a few lines of them ultimately that are coming into force. If there were genuine problems in the sector, you'd expect there to be hundreds of new rules coming in to regulate it. But that's not what the FCA has done. They've given us a fair set of parameters around commissions that the industry has embraced, and that's a good outcome. And beyond that, we're good to go. This is a sector that's had a huge amount of development over the years, continues to do so, and I would certainly say to dealers that they can be confident that they're going to get the support from finance companies to continue to sell cars backed by finance, and that's a critical part of the UK economy, and there is no ultimate challenge to that.
And from what you say, Adrian, it does sound as though the FCA were receptive. It was a genuine consultation process. They were listening to what the FLA and other interested parties were saying.
Absolutely. We've got a very strong relationship with the FCA, very open and transparent with them, as do the dealers. And it's a part of the financial services sector that's right out there in the open. There's no secrets about how it operates. It's transparent, and also it's a sector that has been in constant improvement over the years and will continue to do so, just like all competitive parts of any market in the economy. And I think that's the key thing. I think the thing that a regulator like the FCA looks at is very much, is this a sector that's competitive? And is the competition working well in the interest of the sector's customers? And I think if you look at the trail of the FCA's work on motor finance over the last 6 years, it's given the industry a very good bill of health in those areas where, as dealers know, this is a highly competitive sector. Dealerships and manufacturers and dealer finance companies are competing for customers. And ultimately that works well in the interest of the customer. They're the ultimate winners out of this. And I think that's the FCA's ultimate objective here, is to keep that market as competitive, innovative, and where the way it operates is hardwired towards continuous improvement, like all good industries are. And I think, and that's the industry that I see, and that's the industry I'm proud to represent.
I mean, in terms of the ban and around this, but I mean, PCH, personal contract hire, has been a subject of discussion, debate over the years, obviously around regulation of it and things like this. And we know that, it is increasing its percentage penetration as OEMs enter that space and work with the retail network. But I believe it's exempt from the ban. And what did you make of that? And will it encourage some sales to sort of move and more focus more on PCH, or do you think there's something else behind the PCH element of it?
Well, we expected the FCA to do what they did. There are technical reasons why the FCA was not able to extend the discretionary commission ban to PCH, and that's because their original analysis didn't cover PCH, so they didn't have the evidential basis to extend the ban to it, because that's fair justice in the sense that if you're going to roll out a ban on anything, you've got to have the evidence on which to do it, and as it didn't look at PCH, the evidence isn't there. So the discretionary commission ban doesn't apply to PCH, but the key point the FCA have emphasised is that the other FCA rules and principles do apply to PCH, and that includes the principle of treating customers fairly and acting with integrity. So it's not as if there's a vacuum here. So what the FCA has said is that although narrowly the ban doesn't apply to PCH, if nevertheless operators were selling PCH unfairly in terms of their commissions, then that's still a breach of the FCA's rules. It's still not treating customers fairly, and operators can still expect enforcement action if there's unfairness. And that is the way it is. So it's not as if there's a vacuum here. But that said, this PCH, as you say, is a growing part of the market, and that reflects a long-standing cultural trend as customers move away from ownership of assets towards usership. And that trend will undoubtedly continue, and therefore PCH style models will continue to grow. So it's certainly an area of regulatory focus by the FCA, and I think the key point for the industry here is whether you're providing hire or lease or selling it in dealerships. Ultimately, fairness is the watchword. As long as what you're doing is fair to the customer, it's priced fairly, it's sold fairly, and the right products are lined up to the right customers in terms of their needs, then you're good to go. And that's the issue, really. Is PCH or indeed PCB or HP, is that the right product for this customer? What are their demands and needs? That's the issue. So the industry has a menu of products for all types of consumer. I think the job for dealers in particular is to ensure the customer in front of them is lined up with a product that meets their needs, whatever that product is.
Just as a follow-up to that, Adrian, do you think the FCA will keep tabs on PCH sales? And if PCH sales do go up, they will start to review whether or not they need to take a closer look?
Yes, that's what the FCA said they would do. They said they'd keep a watching brief on not just PCH, but also other areas of the industry where discretionary commission models have existed. For example, premium finance, asset finance. They'll be looking at that, as they always do. And the FCA will always look at where products are increasing in popularity. Because they know that, to be fair, 9 times out of 10, if a financial product increases in popularity, it's for a very good reason, because the market needs it, customers want it, and it's a good product. But 1 time out of 10, it might be for other reasons that the FCA needs to fix. So that is the way a modern regulator operates and needs to operate. So they clearly will be looking at this, but to be fair, there is nothing intrinsically wrong with PCH. It's the right product for an increasing percentage of customers. It exists for a reason, and the issue is are PCH and PCP and HP, for example, are they being offered to the right customers in terms of their needs? That's what matters. If customers' needs change, then take up a products change. So increasing PCH is not of itself an issue.
As long as it's sold the correct way to the right customers that require it, and that's the correct product for them as a customer, isn't it?
Exactly. I think the lens through which the FCA looks at a lot of these things is, was there a good conversation? Was there good interaction with the customer? Were they given very clear information about the product in order to enable the customer to make the right decision about what's the right product for them? And I think that's where, for example, the SAF initiative is really about giving the dealership staff the tools to have that really good quality conversation, whether that's in person or online with customers, to enable ultimately our industry to do the right job, which is to give customers the right products.
And just before we move on to Curtis's final question, but in terms of the dealer as a sector, in terms of because some of this is about paperwork, isn't it, and having that trail of conversation and demonstrate that. Do you think the majority of the retail sector are up to speed with that regulation and adherence to policies that they need to have, or do you think there's some work to do on the back of the recent announcement?
Well, I think, to be fair, I think the industry has embraced these changes and is strongly moving in the right direction. And I think, to be honest, I think the COVID crisis has, if anything, increased the pace of that, actually, as all types of businesses concluding that you've got to be really safe in the way you do things. You've got to be secure. You've got to reduce your risks in order to provide a sustainable business. So the direction of travel is overwhelmingly positive on this. That said, I think it'd be fair to say that probably the larger dealerships have had the capacity to embrace the change quicker than smaller and medium-sized ones. So, for example, take-up of SAF has been faster amongst the bigger dealerships, and so the focus for us at the FLA is to work with medium and smaller-sized dealerships to increase the take-up of things like SAF to enable them to grow in the future. So there's always work in progress, but I think across all dealership types, the direction of travel is exactly the same. All businesses are moving in that direction, and our job at the FLA is to support all those businesses and ensure they, whatever their size or market, they've got the tools they need in order to support sales and self-finance well.
And final question for you, Adrian. As we head into the September plate change. We know there won't be a scrappage scheme, even though there were calls for one. What do you see as the challenges and opportunities facing dealers selling finance? And also, do you expect to see heightened captive finance support programs from the car makers?
Well, obviously, the market is evolving pretty rapidly, and I think we can all be confident that the captive and independent finance providers will be wanting to give dealers as much support as they can, subject to the resources they themselves have available at that time, which is obviously something we're working on and hoping that we get the appropriate support from government to do. So yes, I mean, there will always be a strong will to provide dealers with the support and the incentives that they need to move the metal, as it were. In the long term, though, taking a long-term view, something that we know government, indeed governments all over the Western world are interested in, is the transition to low carbon. Whenever that transition, whatever that target is. So there may or may not be a scrappage scheme in a classic sense of the word, but I think it's pretty much certain that there will be support for that transition to low carbon in some way. And ensuring that support is rolled out in an effective way that doesn't distort competition is a very important part of the conversation we're having with the government. But yes, there will be a different agenda going forward, but certainly expect something on the transition to low carbon.
I mean, all I can say is fantastic, and thanks for joining us on this podcast. I mean, I've personally found it very insightful in the areas they covered. I mean, there's a lot going on, as you know, with obviously what's happening and the impact from the downturn of new vehicles and the challenges facing the new vehicle market on finance and income for the retailers and the sector. Used cars is obviously the area of focus, and we saw what happened in Q1, Q2 of used car transactions and obviously the balance of supply and demand and the conversations taking place around values at the minute of the used car market. But again, it'd be great to get you back on in the future as we sort of start to see the recovery of the impact of lockdown, and just look at what that 12-month picture looks like, because obviously we're trying to compare year to date when we've missed a good few months of the year, haven't we, in activity, and we've lost over 500,000 new car registrations and lost a number of used car transactions. So just remains to say thanks for coming on today, and it's been very insightful and much appreciated.
Thanks very much. It's a pleasure.
Well, thank you very much, Adrian, for what was a timely update on how finance sales are performing now and what we can expect to see over the coming months. So many thanks for that. Unfortunately, that's all we have time for now. You've been listening to this special Motor Trade Radio podcast brought to you in association with eBay Motors Group. Please like and share on social media, as it's important during these times for the dealer community to work together and share experiences and best practices. Many thanks to you for listening and supporting the podcast. Philip and I will be back with the industry headlines on Saturday. Until then, stay safe and stay well.